Hey everybody, my name is Kevin Pura. I am a certified financial planner professional, and today I'm reacting to more Dave Ramsey. We have heated debate between Infinite Banker and Dave Ramsey as our video today. And as always, credit to the original author here, Dave Ramsey, for their video. Let's go ahead and jump into our reaction.
Jim is with us in Nashville. Hey Jim, welcome to the Ramsey Show. How can we help?
Hey Dave, glad to talk to you.
You too, man.
Enjoy your show.
Thank you.
All right. I am calling in response to a video I saw recently that you claimed infinite banking concept was a scam and actually got quite pissed off about it. So I do not agree with that and certain points that you made in that video.
Mm-hmm.
And I have set up a policy for my son when he was 1 year old. He's 5 now.
I'm sorry.
Say that again?
I said I'm sorry.
Yeah, so am I sometimes. No. So I set that policy up for him when he was 1 year old.
Mm-hmm.
It has a $500,000 face value.
Mm-hmm.
We pay $5,373 a year for 13 years,
Mm-hmm.
and it's paid up at that point.
Mm-hmm.
There's a few points that I wanted to discuss that I just didn't agree with.
Okay.
Do you want to just kind of take one thing at a time?
Sure, that's fine. Sure.
Okay. One of the main things was that you claim that the cash value dies with you,
Mm-hmm.
and you only get the face value paid out.
That's true.
That is, well, it's not true if you reinvest the dividends back into the policy.
Dividend reinvestment is not cash value.
I'm going to pause that right there. So, yes, Dave is correct here. When you die with a whole life policy, the cash value does not stay with you. It goes to the insurance company. So, this caller, I think, is going to be a little confused here because he's already starting off on the wrong foot. The cash value does not stay with you. It goes to the insurance company if the insured dies. So do keep that in mind. There's going to be some nuances here, but let's keep watching and listen for the details.
Dividend reinvestment is because you have a mutual company and the policyholders are the owners of the company. And so the profits from the company come to the policyholder and they use that to buy paid up additions. That is not the same as keeping your cash value. That's buying extra insurance with your overpayment.
Okay, so what Dave is saying there is like mostly correct, a little misleading. So with those paid up additions, so let's say you get a dividend from the mutual company like Dave said. There's a few different things you can do with that. Take it as cash. Maybe you want to do a paid up addition. Paid up additions are going to get you a bit more of a death benefit, and also it's also going to increase your cash value a little bit. So Dave is slightly incorrect there by saying it's not going to increase your cash value, because it will if you do get up a paid up addition. However, don't think that just because your cash value is going up from the paid up addition, that changes the fact that that is going to be going away when you die. It still is going to go to the insurance company, that cash value. So we're going to get into the weeds here, but that's the basics. And again, I'll try to put some definitions on the screen because there's going to be a lot of crazy words being, thrown around that maybe some of the definitions are a little loose here.
But it still works out to be having a cash value much greater than the $69,849 we put into it.
But the actual cash value, not the paid up additions, the actual cash value dies with you.
No, because
yes, it does.
Okay, but your death benefit is larger than your cash value. So for me, I looked at it
because you bought more insurance. You know what a paid up addition is? A paid up addition is buying additional insurance. That's why you're getting more at death. Not because you got your cash value, but because you used your policy dividends to buy additional insurance.
But
that's different than getting your cash value. If you took those policy dividends and went and bought a term insurance policy for $100,000, well, you'd get $100,000, but that's not your cash value.
Well, I have a term policy.
I know, but you missed my point. Okay, you're talking about you use the policy dividends. You use the money they send to you because you're in a mutual company to buy additional insurance.
Yes, paid up additions,
Yeah. If you buy a term policy on the side for $100,000 instead with that same money, you would get $100,000 more than your face value. But that's not your cash value. That's additional insurance. They're different.
Right, they are different. In term, you don't have cash value to borrow against.
I'm aware of that, but your point was that you don't lose the cash value, and my point is 100% of the time, by definition, you lose the cash value.
Yeah, so Dave's right there at the end there. The cash value, like I said before, is going to go away when you die. The caller, Jim, here is bringing up the fact that with a term life policy that you can't borrow against the cash value, it's like a loan or whatnot. And again, that is true. That's the benefit of a whole life policy, is that you can borrow against the cash value. But I think we're going to learn here that that's actually not that beneficial. And that's kind of the main thing when it comes to this infinite banking thing, is that you can technically bank with yourself because you're borrowing against something that you already had kind of in your own sphere, instead of going to like a traditional bank, which I think is not a very smart thing to do. And I think it overlooks a ton of different things, which we'll get into. But so far, Dave is mostly right here. The caller is sort of confused, but again, let's keep letting them go and see if they can hash out some of the differences here.
Okay, so as I said, tit for tat. If he lives to be 80, I'm looking at the readout here. If say he only lives to be 80, okay?
All right.
The cash value will be worth about $2 million, but the payout for the death benefit will be $2.6 million. So, okay, technically, yes.
So you take
right.
the cash, you're taking your policy dividends and go buy term insurance with it, and you would have more than you're talking about because you get a better buy on the insurance than you're getting with this rip-off whole life crap.
So what Dave is describing there is basically buy term insurance and invest the difference. The caller is stating that they do have term insurance, but it sounds like they like the whole life policy due to the fact that you can borrow against it and maybe a few other things. So let's listen to see exactly what Jim finds so beneficial about the whole life versus just buying term and investing the difference.
Yes, you would get a high, but you wouldn't be able to use it throughout your life as your own bank. And
well,
I think that's
okay. But here's the thing:
the big thing
that's a side issue. That's a side issue. But your first issue was, he's going to have all this money at retirement. Well, let's just do a little present value calculation on what you put in for a baby. $5,000 a year for 13 years. Do you know what that would be in a mutual fund?
He said present value calculation. I think he meant future value calculation. And actually, I do have my trusty financial calculator. This got me through the CFP exam, this guy right here. So if we need to, we can punch in some calculations and see exactly what they're talking about. So let's see if we can get more exact numbers and we can see what we come up with here.
At age 88, it would be $25 million, dude.
He's going to have that anyway.
No, instead of putting it into this rip-off thing and making 4% on your money, and when he dies, he loses his cash value. If you had put this in a good mutual fund, you'd have 100x, 10x the amount of money, and that's your infinite freaking bank.
Yeah, so we'll double check the math here on Dave. I think he's trying to use that magical like 11 or 12% future mutual fund growth rate, which again, if we're making a projection, I think, so the child is 1 year old and we're talking about when he was like 80 or 88 years old. So we're talking a very long time horizon here. I wouldn't feel comfortable using, 10, 11% return. I mean, if you're going to try to make that big of a far out calculation, which has so many assumptions, I would be more comfortable with like 6 or 7%. And again, you're going to get such widely different, numbers depending on exactly which numbers you're using here.
But we're only putting in 70,000, and he's going to be.
Dude, that's how present value formula works in finance. Look, let me just take the same.
I mean, I understand.
Let's intellectually deal with this for a second, okay? Take the same amount of money when you get off the air and put it in a financial calculator at 11% and pretend it was invested in mutual funds and see what it is when he's 88 years old.
It'll be more.
A whole lot more.
All right, so he's giving us some numbers here. So again, 11% is very aggressive. I'll just use it for the purposes of this calculation. So he is saying 11% per year. I'm not sure exactly which amount of years he was saying. I'm just going to put 80 years. And then let's see. So the payment, I think he said like $5,300. I think he said a year. So we'll just put in. It might have been more or less than that. But I'm just going to put it 5,300. I'm going to assume the present value is $0. We're starting with nothing. What is that going to get us to? So that gets us to. This might show up backwards, but this is $203 million. So again, when you're making these type of assumptions so far out, you could get 200 million, 300 million. You could also get 25 million, depending on if the type of nominal versus inflation adjusted return. So it completely depends on the numbers you're putting in here. But yes, the point still stands. There's opportunity cost. If you're buying term and investing the difference in the stock market, I do think personally that is a much better way to invest your money than whole life insurance with these suboptimal returns. And you got all these crazy fees and surrender charges, and it becomes a mess. But Jim thinks that that's worth it because he can borrow against it. Jim, if you have that much money in like a brokerage account or out there, you can borrow against it. Just like your normal taxable brokerage account. If you have money sitting in there, you can very easily, take a line of credit against that, like a pledged asset line against that, no issue at all. So again, Dave's going a little crazy maybe with some of these numbers, some of these assumptions, but his main point of the opportunity cost is correct.
And he'll have that too. With this, to me, is a way to
no, he doesn't have that too.
To borrow against.
That's called opportunity cost on your money. You put it into something that's going to make him at 88 have $2.5 million, and he should have had $25 million because you screwed up and put it in the wrong thing.
Well, when we screwed up and put it in real estate too, and he's going to get real estate.
Well, then put the money in real estate, but don't put it in this crap.
I have to respectfully disagree.
Well, on what basis? He's getting more money if you put it somewhere else.
But he's able to borrow against this.
If you've got $25 million in mutual funds, you can borrow against it.
Absolutely, that is correct. And again, this is where the infinite banking sort of structure falls apart. Is there's better ways to do this. You don't need to go through a crappy whole life insurance policy to borrow against your cash value. You can build it up in a brokerage account and borrow against it as well. And I think it actually is a more efficient, better way to do it than through a whole life policy.
But he's going to have to wait until he's retired to get that amount of money.
Okay, so you're going to teach him that the way he becomes wealthy is borrowing against money that his father invested for him. That's
real quick. Jim is mentioning, if you have a retirement account, let's say it's in like an IRA, you're going to have to wait till 59.5 to take that out without penalties. There could still be taxes on it if it's just a normal like tax deferred account. However, if we're talking like a taxable brokerage account, I mean, there's a ton more flexibility there. You can take, like a credit line against the assets in there. You can withdraw the funds if you need to. Obviously, there's going to be taxes to pay, but there are ways to fight that. Tax loss harvesting and being smart about your investments. Again, he's being driven away from one clear, practical approach to a more complex approach because he's been sold on whole life. That's not good.
How he builds wealth.
Said
no one rich ever.
I mean, banks use this product to.
No, they do not. You've been watching too much TikTok. Banks do not use whole life.
Okay, so Dave is actually wrong about this. Banks do use life insurance, and I believe whole life insurance specifically. They'll use bank-owned life insurance and like key employee life insurance, so on executives and things like that. So banks do own and do use whole life insurance. That is false from Dave Ramsey there. So we do need to clear that out and be factually correct. You may not think that's the case, but they do. If you have employees, key employees, you do need to cover, if they're gone, that's a big problem. There's benefits to pay out. These things help offset those costs. And that's why life insurance in general is not a bad thing, because it is a very useful thing to have. It's just whole life policies for individuals, it doesn't make sense. But there are niche cases where it makes sense, and there are going to be banks who own whole life policies on employees. That is just how it is.
Not ever. Banks nowhere, no banks sell.
I would respectfully disagree
No,
with
they
that.
don't. They do not use whole life insurance.
What bank?
Well, we could Google it and see what typically banks do with their money, but I believe
Typically, banks never put money. Let me tell you what banks do. They put it in bonds. They're required to. They wouldn't be allowed by federal regulations to put it in whole life.
That is not correct. Banks can purchase whole life, like I mentioned, and there are regulations that kind of guide them through that process, okay? So Dave is incorrect here when it comes to this. Again, though, don't take that as the impression that you think whole life is good for you just because the banks are using it in a specific way. That's not what's happening here.
It's not a place to invest money because it's a horrible investment. The rate of return
4%.
sucks, and when you die, you lose your cash value.
I know, but you also you're making it sound like I'm losing money on the whole.
You
thing.
are. You're leaving money on the table.
You're making it sound like when, not me, but my son, when he dies, that he's only going to be able to get
He's going to have $22 million less than he should have if you had put this in a good investment.
Well, you had mentioned that the cash value dies and you only get the face value. That's
Correct.
Not true.
That is true.
That's not.
I just covered that with you for the last 10 minutes. Paid up additions are the only way that cash value increases unless you're using a universal life program B where you pay extra to get the extra insurance, which is another form of paid up additions.
That isn't coming out of my pocket, though. I put $70,000.
It is coming out of your pocket.
It's coming out of the policy's pocket.
I know. The policy, you put the money in, dude, and then it paid you a dividend, and you chose to buy more of this crap with the dividend, and you're calling that I kept my cash value. No, you didn't. You bought more insurance.
Dave is right here. This is where this caller is completely wrong. He's missing the own point when it's being, I think, pretty well explained to him at this point from Dave. Jim, you got it wrong here. You do, and that's okay. Part of learning with personal finance is sometimes you think things and then you learn the other way and you learn from that and you adjust. But obviously on air, I think Jim's ego is kind of getting to him. Don't get me wrong, Dave's got an ego too. But Jim, I think his ego is kind of getting to him here. He doesn't want to admit that he is wrong when presented with the facts.
Well, I know that I put in $70,000 and at a certain age, it's going to be at age when he's 15 years old, that's going to be paid up.
Yeah, Jim, you understand what paid up is? You understand if you're alive that there's a probability of your death. And so 100% of the time that a life insurance program is paid up, it means that you prepaid it. That's all it means. Because as long as there's a probability of death, there's a cost. So the insurance company has always got a cost as long as you're alive. So there is no such thing as a paid up. That's an industry term that gets suckers like you. That's what it is. No, paid up means prepaid. You paid all of the premiums in 13 years for his whole freaking life in advance. That's why it's paid up. Hey, man, I think you ought to keep it. It's perfect for you. But thanks for the call.
All right, so Dave went, I think, a little off the rails there. I don't think we get to berate the guy, even if he is incorrect. I think both guys here, a bit of an ego, can't really admit that they're wrong. Jim, you definitely were wrong on this one. You should go back and readjust your plan and just say, hey, I didn't get this right. I think for Jim, buying term life and investing in the difference would make sense. Now, does that mean whole life is useless? No, there are cases, very niche cases, where it does make sense. Basically, if you can't buy term and then invest the difference, there probably might be something in that arena for some reason. Maybe it's, you're not able to get the term life insurance, you don't qualify for it, things like that. That's where it can be a possibility, but it's going to depend on the specifics of you personally and the situation for me to say, yeah, you should go look and talk to an insurance agent for whole life, because that definitely isn't in like the top things on my list. So again, that's all I really have for today, guys. Hopefully you enjoyed this reaction. This was a fun one to react to. And if you have any other videos you want me to give my opinion on and watch, just let me know in the comments below. But other than that, have a great day, and I'll catch you in the next one.